All right, I think we can go ahead and get started here. First off, welcome everyone, and good morning, good afternoon, good evening, depending on where in the world you're joining us from. We're very excited to have you here today to discuss severe convective storms and their impact to insurance and reinsurance, as well as our approach here at Descartes for dealing with this evolving risk. So we have a lot to discuss today, so we'll go ahead and jump right into things. So first off, quickly going over the agenda here, we'll start things off with a team introduction. Then we'll kind of define severe convective storm, where it's most problematic. We'll go into the climatology of SCS and Descartes' approach to modeling the risk. Then we'll talk a little bit about the impact it's had to different industry sectors and some of our solutions for dealing with SCS on a parametric basis. And then we'll wrap things up with a Q&A. So feel free to ask questions in the Q&A box, and we'll address as many as we can at the end of the presentation. So jumping into things here with the team intro, I'm Will McMillan. I am on the business development team at Descartes in the US. I'm based in New York, and today joined by Matteo Donati, based in London, senior underwriter. Connor Heffernan, also in London. He's a underwriting data scientist. And then Marshall Crane, based in Chicago, also on the business development side of things with the Descartes US team. So jumping into defining the risk, what is severe convective storm really? I think to set the stage, we'll go over just a couple interesting stats taken from the Aon's 2026 climate report. And so, we're clearly entering 2026 with a shifting risk landscape where severe convective storms have officially surpassed tropical cyclones as the costliest insured peril of the 21st century. In 2025 alone, SCS drove 82 billion in economic losses, with roughly 85% of that number occurring here right in the US. And when we talk about SCS, we're really looking at three main perils: large hail, tornadoes, and straight line winds, or derechos. We'll go into more of these shortly in more detail, but these events aren't just damaging shingles. These are events that are disrupting supply chains. They destroy agriculture. They're a critical threat to infrastructure like data centers, utilities, and solar farms. SCS has also had a significant impact on the reinsurance side of things. So while we've seen a return of capacity in many cases, structurally speaking, reinsurers are still maintaining very high attachment points. And so at the portfolio level, this really amplifies that death by 1,000 cuts theme, given the high frequency nature of these storms. And so as a result, primary insurers and corporate balance sheets are being forced to retain more of this volatility. SCS is no longer seen as a secondary peril. They're now very much primary drivers of losses and business interruption. And so today we're exploring how parametric insurance and reinsurance can complement traditional offerings to create more well-rounded, robust insurance programs and help bridge some of these gaps between economic losses and cover. Now, to show you how we model these perils and build out these solutions, I'm going to hand it over to Matteo and Connor.
Thank you, Will. And I'm going to start by giving a high-level overview of SCS risk. We can see from this map of hail risk worldwide that the US is a major global hotspot. And this is due to few ingredients combining together exactly in this area. You have warm air from the Gulf colliding to dry air, then cold fronts, and generating this very powerful thunderstorm. If we move to the next slide, we can see more in details how hail is formed. And basically, this thunderstorm can have a very strong updraft that brings water droplets to freezing level, where even the intensity of the updraft, they can remain at this level for a long time, producing very, very large hailstones. And if we go to the next slide, we can see how at the cart we use radar data to model these risks. So the US has a very strong and resilient radar infrastructure across all states. And we acquire this data, we process it to clean it of any potential artifacts. And then we can obtain daily footprints of hail that show at any specific location the hailstone that happened at a given time. And if we go to the next slide, we can see that we rely on the multi-radar, multi-sensor product, which is published by NOAA, the National Oceanic and Atmospheric Administration. So this is public data that anyone can access, and clients and broker can access both the settlement data and the historical data showing the risks at any specific location. And we use these to settle our contract. And going to the next slide, Connor will talk a bit about our approach to tornado.
Thank you, Matteo. So I'm just going to give an overview on tornado risk in the US and how we retrieve the data for our modeling, pricing, and claims. So tornadoes are localized, violently rotating columns of air that are present in SCS events. Risk concerns a very large part of the mainland United States. Even though Tornado Alley would be considered going from Texas up north, tornadoes actually do span much larger areas, as you can see in the graphic here. For instance, in 2025, there was a very large outbreak in March, which impacted severely Arkansas, Missouri, Illinois. But there was also significant impact in Mississippi and Alabama. If we just go to the next slide, please. So the question is, how do we then get tornado data and then use it for our purposes, given that they are highly localized events? So the first thing that's needed to be done is to estimate the intensity of a tornado, which the National Weather Service uses what's called the Enhanced Fujita or EF scale, which assigns an intensity rating along a tornado's path. So at EF 0, it's the lowest number on the scale, and that corresponds to pretty minor damage, so nothing too severe. But then as you go up in scale, particularly once you hit EF 3 and above, that's when the damage from tornado can be quite catastrophic. And the way that the data is handled by the National Weather Service is through a combination of ground report surveys and satellite data. And what they do is they put all this together like you have in the image shown here on the left, which produces the footprint of the tornado with different bits corresponding to the different EF portions of its track. So you can see here it was mostly an EF1 tornado, but then you have EF2, in yellow, and then going into EF3 in orange, and then a little portion of EF4 there in the center, which would have been the most destructive part of the tornado. So the way that we use this data is using these types of tornado footprints, which the certification agent consolidates if needed, so that we have a well-defined tornado footprint for an event. Now I'm just going to pass back to Matteo to go through the next slides.
Thank you, Connor. And SCS reinsurance, we're going to look at our solution. This is a big area of focus for us. As Will mentioned at the start of the webinar, attritional SCS losses have been one of the main drivers of insured losses in the US. And traditional capacity in the last few years has been very hard to find for this aggregate cover. And parametric insurance has stepped up and filled this gap, offering a new innovative solution. Our approach to reinsurance is based on a model loss index, which is a proxy of the actual losses of a cedent, on which then a reinsurance structure specific layer can be chosen. The base of this model, our hazard, is what we shown before for hail and for tornado. Radar data for hail, EF scale for tornado, and for straight line wind, a model based on atmospheric variables. And we ingest this data, and then we look at the asset level for a portfolio of a cedent, and for each event we overlay these event tracks to the portfolio, apply our vulnerability functions, which are tailored to the specific asset of the portfolio that we are considering, and then a financial layer to apply the policy terms, limits, and deductible to obtain our financial loss. And this is done across all events in a year, and then aggregated to obtain a final number for an estimated loss, model loss for a given year. If we move to the next slide, we can see for one specific event how this works in practice. This is a simplified fictive events for hail, assuming a very small portfolio. We can see at each location. We look at the hazard intensity for the specific peril. We apply our vulnerability functions that are customized for the specific cedent to obtain a ground up loss, and then we apply the policy term to obtain a model claim for each specific asset. Then this is done across the 3 SCS peril, across all events in a season to obtain the final value of the index. And if we go to the next slide, we can see an example of how this is working. And we can think about a small US Farm Bureau with exposure to 1 or 2 states, which has suffered very severe SCS activity in the recent years, big losses in 2023 and 2024, and hasn't been able to find traditional capacity to fill the need to reinsure SCS in the aggregate. And we can offer our solution. Here on the right, we show our model would perform to show the basis risk, comparing it to the actual loss history of the cedent. And then on this model loss index, a layer can be chosen by the specific cedent in order to be able to reinsure these type of losses. And in case of an event, a quick payout would happen soon after the end of the season. And with this, I'm going to give the word to Marshall to go over our other use cases.
Thanks, Matteo. Yeah, now that we've seen what we can add to the reinsurance market, let's look at how we can attack these perils for the primary insurance market. So first of all, we're seeing a lot of similar inquiries come in the kind of broader manufacturing and industrial space, where tornadoes are increasingly seen. These companies are increasingly seen as prone to tornado events. High value locations, very impactful to the supply chain, and despite having strong insurance programs, they do not feel adequately covered, not for necessarily a hail event that may cause cosmetic damage to the roof, or a lower level sub EF level wind event. They're really concerned about a severe tornado event coming through, the destruction to the building, to the supply chain, the extra expenses involved, the income loss, the high value inventory on site, and even the environmental and pollution impacts, depending on the materials at that site. So looking at the type of destruction this can cause, these tornado events, we'll look at Jeffersontown tornado in Kentucky, Jefferson County last year. This was an EF3 event that rolled through, and over 30,000 customers were impacted from LG&E and KU, the power company, local power company. J&J Transportation had half of its building torn up. Warren Technology, alongside JSO Wood and Ogle Equipment, had their roofs completely ripped off. And then Garner Industries had its facility completely destroyed, ended up laying off 62 people, with significant debris and property removal costs. So with these high value locations that are critical to the greater supply chain for these companies, and the materials involved and the people involved, there's a lot of associated costs and impact that we can help address, either in a deductible buy down, kind of addressing that deductible or retention, or just addressing the income and harder to define or predict costs to the greater organization. And we're seeing increased construction for these type of for this sector in tornado prone areas. So if we go to the next slide, we can talk a little bit about how the product works. But we essentially have one of two main methods we use for a single location that has high values and very large property. We can put a coverage area around that location, and we'll pay out as a percentage of the limit based on the percentage of that area impacted by a tornado. So this can help address a very large facility and a partial loss. Or we can look at more of a binary approach where any EF scale tornado impacting that coverage area would result in a full limit payout based on the severity of the event. So in this case, this was a deductible buy down. Again, a similar type inquiry we're getting coming straight from the owner of the manufacturing company, but they had a grouping of locations, a tight grouping in Tornado Alley. Their concern was not with hail damage. It was not with a lower level wind event. Their concern was a tornado coming through and impacting at minimum a couple of these buildings based on the grouping, if not all of the buildings. In this case, they had a $100,000 per building deductible. So if that type of event would occur, they would be dealing with a catastrophic loss to their buildings, to their operations, but also be out of pocket for a significant deductible burden in their eyes. So we came in, assigned a $100,000 limit per building, and based on the tornado severity that impacted the building, as long as it touched any of those buildings at EF1, EF2, or above, they would get a corresponding payout, which was seen as a very effective way to help address that deductible burden. And for the manufacturing space and the product in general, the rapid liquidity and the flexible use of funds that they would receive post-event is really seen as valuable, and we'll get into that more with some of the next verticals. So data centers, kind of a somewhat similar profile to the manufacturing space, but just on another unique level of values at these locations. So we're seeing data centers already in operation, but also in construction or in the planning phase, very much in the middle of the country and on the coasts where we're seeing tornado activity as well. But we're seeing huge facilities, $5-10 billion facilities going up in Texas, in Oklahoma, in Nebraska, in Iowa. And despite significant capacity available, there is still just not enough capacity in the marketplace to address the construction phase or the operational phase for these type of facilities and the high value of their contents. And with the type of properties, again, they're not as concerned with the lower level events. They're concerned with the highest severity tornado events. If we can go to the next slide, just touching on the different areas that are vulnerable to these SCS events in the data center space. Again, the construction phase, so we can protect the contractors, and with some of these, billion-dollar buildings, multiple billion-dollar buildings, as part of a 4 or 6 or 8 building phase of construction. When you have a 3 to 5% deductible on a billion-dollar building, that's going to amount to $30 to $50 million in deductible burden. So we can come in and address that deductible for these severe events, both on a per building, but then throughout each phase of construction, with the coverage period matching up with the construction phase, whether that be short term or long term. Very flexible there. We're protecting the lenders and the financing in place that these type of events can threaten the debt servicing. So we're protecting that party. But then also in the operational phase, purely from a property standpoint, from an income standpoint, and from the high value of the equipment, and even the disruption to the infrastructure, and the downtime can be very costly. So a lot of additional ways we can address data center exposures, but this is SES focused here. Clearly a very strong fit here, continuing to see a lot of success in the data center space and a lot of inquiries coming in. If we can go to the next one, solar farms. So a pretty clear match for what we can do, both on the wind side and on the hail side. So these are very vulnerable assets in tornado and SES prone areas, a difficult insurance market. And in this case, we can use our satellite-based wind product to address tornado and sub-tornado level wind events. Straight line wind, we can use very granular satellite imagery to detect what percentage of the solar farm was impacted by this, either a straight line wind event or a tornado, and compensate based on that percentage and the assigned limit. So we can get very granular with this and match this up very effectively with the actual loss sustained, even though we're paying out from a parametric standpoint. We can go on to the next one. We'll look at hail for solar. Again, a pretty obvious fit here, an alternate source of hail capacity in a very difficult market. The way the hail product works for us in the primary insurance space is it triggers based on the hailstone size experienced at the location. So we'll create a coverage area, and based on the hailstone size and the percentage of the impact to that coverage area based on the payout structure will correspond with the payout. So we'll show this in action here using the Fighting Jays hail loss example in Central Texas. This was not a client of ours, but a high profile example of how hail can impact these utility grade solar projects. We put together this kind of hypothetical payout based on similar profile clients that we have and what we see them purchasing, but we can match up the payout structure with the hailstone size very precisely with the what these solar panels are rated to withstand or to address beyond what they are warranted, protected by warranty from a hailstone perspective. So in this case, again, with educated guessing from similar clients, if we had assigned a $40 million limit to this solar farm and this payout structure, they would have been able to recoup $26 million and would have been in a much better position than than we see with other insurance programs. And this is an example of what a hailstone radar swath would look like, and we're able to go back and back test based on the severity there and put together this this payout structure. So in addition to solar, a lot of other different industries we can look at. We'll look at greenhouses. We'll look at open lot for dealers and for large fleets. We'll look at agriculture, hailstone for crop. Some pretty clear fits of where we're able to match the hailstone size to the particular vulnerability of those assets in more difficult markets to obtain hail coverage. We can look at just about anything, but it comes down to looking at being able to match that payout and the hailstone severity with the expected damage and the vulnerability of the underlying asset. So if there's a more traditional property, but they've suffered hail losses in the past, we can go back and match that loss with a payout structure to protect them going forward. A lot of pretty interesting use cases for hail, but again, it's matching up that payout and the hailstone size with the vulnerability of the underlying asset. And here are some very clear examples where we've seen uptake and continue to see success.
All right, thank you guys. We've now kind of reached the Q&A portion of the webinar, so a few questions have come through. Please feel free to take this time to submit some more. I think we'll kick things off with the first question I hear. If the claim payout is based only on the event parameter, how can you be sure the payout matches the actual loss? And so I think this question really gets to the heart of parametric insurance and the difference between parametric products and traditional indemnity-based products. Well, first off, there's been a lot of new advancements to the technology and the data that we leverage to put these policies together. We're able to more accurately track these events in real time, thanks to improvements to radar, satellite, on-site sensors, and then also the modeling capabilities allows us to better understand the impact they have. And then two, I think it's very important from the buyer's perspective to understand how they're using the parametric, specifically, and I think that also helps inform the design of the index for the cover. Are we covering a deductible layer, an excess layer for more high severity based events, Are we covering something that's very specific but excluded under traditional insurance, like non-damage business interruption? And so I think it's being very intentional with what you're purchasing and understanding what scenarios it's meant to cover, and then also perhaps just as important what it does not cover, and where your parametric is not responding. And so it just takes an educated buyer, a careful trigger design, and then harnessing accurate and reliable technology. Can we join brokers on calls with insureds to explain the coverage? Yes, this is absolutely something that we do and have the capacity to. And if the broker is willing to put us in the call with the client or the insured, then we're happy to join those discussions. Let's see. Can you comment, how does the trigger mechanism of a parametric policy, differing from traditional all-risk property insurance that relies on physical damage, affect the application of parametric indemnification for non-damage BI losses? How should the other insurance clause be addressed by Descartes to prevent overlaps or conflicts with other coverage? Marshall, did you want to take that one?
Sure. We're triggering based on the event, and there is some flexibility in how you can claim the funds, as far as any loss associated with any financial economic loss associated with the event will qualify for payout based on what you're eligible, based on the severity of what triggered. So we're not going to, we're not going to be adjusting that. You simply have to attest to the amount that you're claiming is the amount of your loss was no less than the amount that you're eligible to claim. So there's no exclusions, extremely flexible use of funds, and with us being upfront, that does often help with other insurance, as far as the different parties involved, being able to have some flexibility in adjusting the total loss. We're not normally seeing issues, with the other insurance clause and duplicate coverage or anything like that. So it's not something that has come up, but is usually well addressed by the other insurance clause. And it depends what we're using the coverage for. Is this kind of is this to address a particular uncovered or gap in your BI? Is this to address a deductible, or is this kind of a wraparound coverage? And we're just rarely seeing instances where there's a problem with how the coverage interacts with traditional insurance, especially when it comes to really severe events, where you're going to find use and gaps in your traditional program following a very severe event. So we can certainly get into that on a case-by-case basis, or dive a little bit deeper another time.
Yeah. Thanks, Marshall. Yeah, I'll just agree. It really, that goes back to kind of the careful design and the structuring of the parametric policy, and knowing exactly how what you're using the funds for, what gaps specifically in the traditional property program are the parametric funds covering, and because it's a source of capacity that ultimately does different things than the traditional property program that might be on a risk. Question came in: how long does a tornado footprint take to produce after an event? Connor, I believe you could answer that one for us.
Yeah. So usually it'd be about a few weeks, but since the data collection and consolidation is done locally, it also depends a little bit on each local office that's in proximity to where the event happened, as well as the number of tornadoes that there were during an outbreak. So typically a few weeks, could be a little bit more, depending on those two factors.
Got it. Thank you. Would parametric insurance provide coverage for a grain dealer storing product in third-party silos for losses arising from spoilage or deterioration during extended storage periods? Marshall, this one's kind of back to you, asking about kind of the impact to third-party grain silos.
Yeah, it's definitely something we can consider. It's a great use case of parametric, trying to address that contingent BI and addressing the supply chain, greater supply chain of a key supplier, if I'm understanding it correctly. But something we can certainly look to address. We just have to have a reference point for what severity or what conditions will lead to that spoilage. I'm missing, lost the rest of the question, but if we can look at be informed on what conditions would lead to that spoilage, whether that's rainfall or flooding or particular seasonal weather conditions or a particular event. If we can know that going in and be informed on that, then that's certainly something we can address. But from an overall contingent BI and supply chain protection standpoint, certainly a very strong use case for parametric. It does not have to be an owned asset to qualify.
Exactly. Yep. That kind of economic loss, whether or not it's actually, a non-owned asset is damaged, that economic loss or contingent loss can be absolutely addressed by a parametric policy. Matteo, here's one that's probably for you. What is the minimum photovoltaic park size you would offer hail parametric for?
We can look at any size. A lot of the projects that we worked on have a very large footprints, but we're able to look also at very small size. As we showed, the MRMS radar data is very granular, so that allows us to offer coverage for a great spectrum of assets.
Perfect. Thank you. And then there was another one also related to hail. Here, 1 second. Let me find this. So how flexible is our hail product for solar? For instance, can you write it based on the stow angle of the trackers at the time of the storm? So varying coverage levels for stowed versus non-stowed modules. That's a great question.
Yeah, it's very flexible. We can look at many different stowing angles, consider also the thickness of the glass of the solar panels installed. And when a submission is sent, we can review all the engineering reports to tailor a solution for the specific solar panels. So very flexible.
Good. Okay, then we have, in the event of a triggered event, is the insured responsible for proof of loss / expenses? If they have an actual loss of 500K, but the parametric limit is 1 million, will they receive the full 1 mil? This is, again, a very good question and kind of gets to that proof of loss requirement that's part of a parametric insurance policy. Having that proof of loss statement is what keeps this insurance as opposed to some other kind of financial instrument. What happens in the event of a claim is we'll provide an event summary, which is basically kind of a summary of the specific event parameters and the total eligible claim payout based on the terms of the parametric policy. And so in order to actually kind of receive those funds, the client produces what's called a proof of loss or declaration of loss statement. And it's basically a document that says, essentially, yes, we had an economic loss related to this event, and the full scope of that loss is no less than what we're recovering under the traditional policy. And so in this scenario where they estimate the total economic loss to be more to the tune of 500 grand when the parametric policy is prepared to give them 1 million, they would write 500K in that blank, and then we would only pay the 500K. Now, realizing that this is all taken care of in the immediate aftermath of an event, the full scope of losses may not be obviously at the time of the loss. And so there is in the policy wording typically an extended period of time where the client can actually submit additional proof of loss events, and we'll kind of top up them based on the additional proof of loss records we see. So if within the first 30 days they submit proof of loss, claim 500K, and then maybe a few months go by and they realize that this event has actually impacted them more to the tune of 700K or the full $1 million that they were originally eligible for, there would be kind of supplemental payments on top of that to kind of top them up based on the full parametric payout they were eligible for. Probably have time for just a couple more. One is, are these type of coverages also common in Europe, and what is the average rate for this type of product? What is your outlook for the European market? I don't know if Matteo, Connor, you guys could maybe take this one. It is difficult to talk about rates without also speaking about the specific kind of trigger threshold and peril we're discussing, but maybe generally speaking, we can touch on some of that.
Yeah, for the European market, the solution is less standardized. In the US, we can rely on great infrastructure for radar and great reporting for tornado. So in Europe, it depends country by country, and we have more bespoke and ad hoc solution. So we're very happy to look at any submission regarding Europe, but the different solution might look different depending on the exact location.
Thank you. And then one more question. Are lenders generally comfortable with parametric? Maybe I can take this one. I guess the classic insurance answer is it depends. In some cases, depending on the type of lender, the type of project, those requirements that they have in place, parametric can absolutely provide that meaningful capacity. There's also, when dealing with lenders, a big kind of educational hurdle to get across as well, and avoid simply kind of looking to check a box on insurance requirements, but really kind of understanding how the cover works and how it's meant to address. We've seen some lenders actually really almost prefer the parametric for certain perils in certain geographies, just given the very transparent, frictionless payout nature of it, that economic loss scenario, and just the speed of payouts and less of a kind of a headache on the traditional claims adjustment side. We've also seen scenarios where lenders are requiring maybe full replacement cost coverage, unwilling to kind of deviate from the norm of their insurance requirements, and so it can be additional hurdles. But really, I guess the answer is it depends. In some cases, renewables, we see that lenders are often requiring limits of insurance that are sometimes just unattainable in the traditional indemnity market, and so parametric can be a great source of additional capacity there, as well as digital infrastructure, data centers, again, where the value of the concentration of values in a particular region are higher than what the insurance market can put together on the traditional side. And so parametric policies are being used to provide additional capacity to appease the lenders. So it's kind of a it depends answer, but that really is kind of the case here. There's a lot of other questions. I think our plan is to kind of address each of these and send out a kind of a follow-up email. We'll also share the slides that we went over today, but we'll try to address the rest of these questions. But that unfortunately is all the time we have, and so thank you everyone for joining. Hopefully it was insightful, and we're available to answer any other questions that may come up. So until our next webinar, we'll see you guys later. Thank you.